Okay, so we did talk about the working capital management in our previous session, and we are going to start off again today. And the topic that I'm going to cover up is the cost of capital. That's what my main focus is going to be in today's session. But at the same time, when we do talk about the cost of capital, we do come across few things pertaining to the sources of finance also. So we're going to cover that also when the relevant things are going to come up. So what I'm going to do is that I will be using the latest past examination paper of the ACCA, and that latest past examination paper of the ACCA is the September-December 2023 examination paper that I'm going to be using, and I'll be doing the questions from that specific examination because there are questions that are about the cost of capital which I'm going to cover up. Okay. Now what happens is that there is this one specific question in which what it is say, it says using the market values, calculate the weighted average after tax weighted average cost of capital of Marble Company. And here the details are, there is this dividend details and things like that, the convertible bonds, etc. is the given information over here. Then if I move a bit forward and if I talk about the next aspect of this question, the next aspect of this question is it talks about the relative merits of capital asset pricing model and the dividend growth model in calculating cost of equity. Then we have got the third one, which is explain the connection between the creditor hierarchy and the relative cost of sources of finance. So that's what we have. So we are now going to do this thing that we are going to talk about the first part, which is about the establishment of the cost of capital. So let's just start off. So cost of capital is what we are going to start off with. So whenever we talk about the cost of capital, which is also the weighted average cost of capital, which is also called the weighted average cost of capital. How do we calculate it? We calculate it like this: KE multiplied by E upon E plus D KD multiplied by 1 plus T multiplied by 1 minus T multiplied by D upon E plus D. Where what happens is that the KE is your cost of equity. Capital E is your market value of equity. Capital D is your market value of debt. T is the tax rate. Now, when we talk about the cost of equity calculation, so with respect to cost of equity calculation, there are different methods of establishing the cost of equity. One of them is you could establish the cost of equity using the capital asset pricing model. And the other one of them is you could use the dividend valuation model. So with respect to the capital asset pricing model, the cost of equity is the risk-free rate of return plus equity beta multiplied by RM minus RF. And when we talk about the dividend valuation model, so with respect to dividend valuation model, what actually happens is that the cost of equity is going to be D naught 1 plus G KE minus G. And when we actually rearrange this formula, the formula actually becomes what? So the formula actually becomes this. I repeat, the formula actually becomes this, which is KE is equivalent to D naught 1 plus D divided by P naught plus G. That's how the formula becomes. When we talk about this specific formula, the different components are like this. RF is your risk-free rate. PE is your equity beta. RM is the market rate. Now, so when we talk about the cost of equity, this is how we do it. With respect to the cost of debt, always remember we would always calculate after tax cost of debt. What we would do is that we would always have the after tax cost of debt. So it depends upon that what type of debt is it. Redeemable, irredeemable. So when we talk about the redeemable debt could be non-traded, could be traded. The irredeemable debt is simple. So respect to the non-traded debt, simply what we do is that interest percentage multiplied by 1 minus t. For the traded debt, what we do is that we calculate the IRR. For the irredeemable debt, what we do is that the cost of debt is going to be after tax interest divided by market value of the debt or the market value of the bond. After tax interest divided by market value of debt or market value of the bond. Now what I'm actually going to do is that I'm going to talk about this question and would see that how exactly are we going to be able to answer this. Now this is one of the question about the marble company where it says marble company wishes to wishes to calculate its weighted average cost of capital as part of the review of the company and so and so. So here is the question in front of you. Can you take 2-3 minutes and try to do this? Okay, now let's start off. So if we talk about this specific question, what is the relevant information here? It says Marble Company wishes to calculate its current weighted average cost of capital as part of the review of the company's performance in delivering shareholder value. Dividends per share paid to ordinary shareholders in recent years are as follows. So you've got the dividends for 2007, 6, 5, and 4. The dividend for 2008 of 0.84 per share is due to be paid. So the recent dividend of 0.84 is to be paid. Marble Company has an issue 226 million ordinary shares with a nominal value of this, and a current cum dividend share price. Cum dividend share price means it is inclusive of dividend is 11.93. Now, first of all, what happens is that when we have to calculate the weighted average cost of capital. So for the weighted average cost of capital, it is very, very important that what you do is that you establish that what are the different sources of finance that you have. You establish its cost in terms of percentage, its value in terms of dollars, and then the cost in terms of dollars. So if I talk about the equity, so I can simply directly say that the value is going to be what? Is going to be 226 million shares multiplied by 11.93 minus 0.84, because we don't use the cum dividend price, we use the ex dividend price. I repeat, we don't use the cum dividend price, we use the ex dividend price. So basically what would happen is that okay, so what would happen is that this is going to be like this. Now the next thing is that it says Marble has an issue 226 million ordinary shares with a nominal value of this, and a dividend of this much is to be paid. So what I'm actually going to do is that I'm going to talk about the cost of equity using dividend valuation model. Okay. Then there is this Marble has also an issue 20 million preference shares. There are preference shares, 20 million preference shares, each with a nominal value of $1 per share and a current ex dividend market price of 2.27. So it's like 20 million multiplied 2.27. A 25% per share preference dividend has just been paid. A 25% preference shares dividend has just been paid. So we'll talk about this also. Then it says Marble Company is partly financed by 6.5% convertible loan notes with a total nominal value of 94 million. With a total value of 94 million, interest on loan notes has just been paid and loan notes have an X interest market value of 107.11 per $100 nominal value loan note. So what do they have? They've got this par value. Now, so it is simply gonna be 94 divided by 100 multiplied by 107.11. कितना है? चल दिया को दे दे. चल दिया को. Right? Okay, so this is what the convertible loan note is. At the end of 5 years, the loan note will either be redeemed at nominal value or converted into 8 ordinary shares. Future share price growth is expected to be this. Loan notes are secured and the assets of Marble Company, the company pays corporation tax at this. So what have I been able to do? I've been able to calculate the value of this. I've been able to calculate the value of the equity, the preference shares, and the convertible loan note. Now we need to calculate the cost of equity using the dividend valuation model. So what are the components for the dividend valuation model? You've got the cost of equity, D naught, P naught, and then G. So D naught is the current dividend. The dividend for 0.84 per share is due to be paid shortly. So last year dividend was 0.8. Current year dividend is 0.84. 0.84. The P naught 11.93 minus 0.84. The growth rate. You have to calculate the growth rate. So you could simply use so you have to use the growth using the geometric mean method. How would you do that? You simply have got this 0.6, 0.69, 0.73, 0.78, 0.8, and then 0.84 also. So you've got, how would you do it? You would simply do it like this. You would say 0.84 is equivalent to 0.69 multiplied by 1 plus g power. It's like it was 0.69, then 1, 2, 3, and then 4 times it has grown. So your growth rate is going to be what? Is going to be 0.84 divided by 0.69 power 1 upon 4 minus 1. So hence the growth rate is gonna be this 5.04%. Just do watch it. See how I have calculated the growth rate. Do check how I have calculated the growth rate, please. Yeah, please do check how I have calculated the growth rate. Okay. So now what happens is that the growth rate is 5.04%. So when we talk about the cost of equity, the formula for the cost of equity is D naught multiplied by 1 plus G. This is going to be divided by P naught, and this whole has to be plus G. So you have got, okay, you have got 12 point something, 13% is your cost of equity. So what have you got? You've got 13% as the cost of equity. So your cost of equity is 13%. So if you multiply the cost in terms of dollars, it is gonna be this into this. Okay, now what next is there? So we have established the cost for the ordinary shares. Now what we need to do is that we have to establish the cost for the preference shares. So the formula for the cost of preference shares, which is K preference share, is equivalent to preference dividend divided by X dividend price. So preference dividend is going to be how much? Is going to be 25% per share. 25% multiplied by 1. Market value is 2.27. So the cost of preference share is gonna be this divided by this, which is 11.01%. What is it? It's 11.01%. So you'll have the cost of the preference share, which is 11.01%. Hence the cost in terms of dollars is gonna be this. Now you've got a convertible loan note also. So first of all, which option is attractive? You have to see which option is attractive, conversion or redemption. You got to see which option is attractive, the conversion or the redemption. So if we talk about the conversion or the redemption, the conversion is gonna be what? It's like a loan note will be converted into 8 ordinary shares. Future share price growth is expected to be 6% per year. So you would say that conversion is gonna be 8 shares multiplied by, we had the current ex dividend price that was 11.93 minus 0.5, and then you would do power. How many years? After how many years it is going to be there? 5 years. Okay, just a minute. One 122.3673 is the conversion. The redemption is gonna be 100. So conversion option is attractive. So what will you do? You'll have to do it like this. You'll have to say, okay, the cost of convertible loan note will be what? Here, cash flow. So the outflow is gonna be 107.11. The interest is gonna be 6.5% multiplied by 100 multiplied by 1 minus 0.26 because 26% is the tax rate. And in the fifth year, we would have this plus the conversion value, which is this. Now what we need to do is that we need to calculate the IRR on this. So it is simply gonna be the IRR on this, which is going to be 6.97%. So the IRR is gonna be 6.97%. So on the basis of this, if we are gonna try and do the calculations, So hence, what do we have? We have got these different sources and the values of these, which is going to be this and this. So resultingly, what happens is that if you have to calculate the weighted average cost of capital, the weighted average cost of capital is simply going to be the cost divided by this value. So it's like 12.734. 12.73% is your weighted average cost of capital. Now I'm waiting a bit. Do let me know if you understand this. Yes, because you see what happens is that Alina, we try to calculate the cost. The cost of a debt is always 1 minus t after tax. So that's why the interest that I have actually used in here, that interest is going to be 4.81 etc. This is basically after tax. What, how have I calculated? 6.5% multiply by 100 multiply by 1 minus t. 6.5% multiply by 100 multiply by 1 minus t. Yeah, is everyone okay with this? Okay, with respect to IRR, I've simply used all the cash flows. You have to show the outflow, which is like this, and then all the inflows. If nothing is mentioned, it's always going to be after tax. When nothing is mentioned, it is always going to be after tax. Okay, you don't have to apply that high and low things. Just don't apply anything. From this ACCA CB examination perspective, all that you have to do is that you just have to apply this formula and you get the IRR. The way I've done, just apply this. The way I've done, just apply this formula. I'll share one of the videos that I have already prepared. In that video, you can easily see how the different functions will be used. It would be mentioned in the question, Alina. It would always be mentioned in the question. For the MCQ, every area is important. Sure, it's in the WhatsApp groups also. Okay. Basically, see what happened is that we had a choice that whether we are going to opt for conversion or redemption. See, he actually mentioned to you that this is a 6.5% convertible loan note with a nominal value of 94 million. Interest on loan note has just been paid so and so, so and so. He says at the end of 5 years, the loan notes will either be redeemed at nominal value or converted into 8 ordinary shares of Marble Company per loan note. Future share price growth is expected to be so and so. So think about the holder. If you are the holder of convertible loan note, what will you do? You will obviously opt for the strategy where you will get the maximum value. So see, the current you'll get 8 shares. The current share price is 11.93 minus zero point 0.5. I think zero point 0.5 is correct or what? I'm sorry, it's incorrect. It should have been 0.84. It should have been 0.84 because it was 0.84. That was the dividend. So you don't use the cum dividend price. You use the ex dividend price. And then the share price is expected to grow by 6% per year for a period of 5 years. That's why I've done it this way. Okay. The preference share can be debt, can be equity, but the tax authorities rules are like this. The tax authorities do not allow the taxation on the preference shares. So you don't claim the preference dividend as an expense for the tax purposes. For accounting, yes, you can, but for the tax purposes, you don't. So preference shares, the tax is not claimable expense on preference shares. Okay. So we are done with this specific question. Now we move on to the next parts of the question. And what are the next part of the question? So it talks about discuss the relative merits of capital asset pricing model and the dividend growth model in calculating the cost of equity. Now, see what is this theory portion all about? I've compiled some of the answers for you, but let me just give you. See, it's a 4-mark requirement. So you would talk about the CAPM advantages. You would talk about the dividend growth model advantages. Ideally speaking, 2 advantages each. Ideally speaking, 2 advantages each. So it is not a rocket science, just 2 advantages each. Yeah, can you think of these advantages, please? Yeah, can you think of these advantages, please? Yeah, can you suggest some advantages and disadvantages? Some advantages for both of them right now. Just anything you can guess. What is the important aspect of the dividend this capital asset pricing model? Okay, so one of them is basically it incorporates systematic risk. That's one thing. What else is there? Assumption that investors hold diversified portfolios is also relevant, easy to calculate, incorporates. Okay, so there are some of these advantages. Now, what are these dividend valuation model advantages? Based on the actual information of the entity, that is share price and dividends. So one of them is it is based on the actual information of the entity, which is the share price and the dividends. Values the rate of the investor and not the cost of capital. Simple. Again, it's also simple to understand. So this is also another advantage of this capital asset pricing, this dividend valuation model. So you have to actually mention about the advantages and the relative merits of both the CAPM and the dividend growth model while calculating cost of equity. Now, next is basically you have to explain the connection between the creditor hierarchy and the relative core cost of sources of finance. So what is the examiner asking? What is the examiner asking? Anyone has an idea? Yes, I mean like just write short paragraphs. Just write short paragraphs. Okay, let me just guide you a bit. Yes, you could write the packing order theory also, but let me just guide you people a bit that what exactly is he actually referring towards. Basically, what happens is that, see, as an entity, you could be provided money by different people. Your creditors could be many. It could be bank. Your creditors could be many. It could be bank, supplier, general public, financial institution, etc., etc., etc. Now, so basically, when we talk about the creditor hierarchy, what exactly do you mean by this creditor hierarchy? Try to understand this. With respect to creditor hierarchy, the concept is basically, let's say if the company is liquidated, who will get money first is basically the hierarchy. So generally what happens is that the winding up costs are the first ones that actually comes in, that you have to actually give, you have to pay for the winding up cost. That's the first thing. Then what happens is that secured loan, then unsecured loan, preference shares, and then in the end, you've got the ordinary shares in the end. That's what the last one, that is the ordinary. Okay. So basically what happens is that you've got the winding up cost, secured loan, unsecured loan, preference shares, ordinary shares, etc. Always remember, always remember the risk and return have got a direct relationship. The risk and return have a direct relationship. The higher the risk, the higher the return is. Just think about it. The ones who are who has given you secured loan, they are facing low risk. Unsecured loan slightly more. Preference share more than that. Ordinary shares very risky. So basically, what happens is that the cost of each source of finance would be dependent on the risk that is being undertaken by the creditor. Higher the risk, higher the desired return, and hence the cost. And hence the cost, right? So cost of each source of finance would be dependent on the risk that is being undertaken by the creditor. Higher the risk, higher the desired return, and hence the cost. So basically, what do you need to do? You need to explain to the examiner. Your answer would actually be, you would relate, you would explain hierarchy, you would explain concept of risk, and you would explain the cost associated with risk undertaken, and then just connect it. So basically, This is how you would actually write it down. This is how you would actually write it down. If you have got the BPP or the Kaplan kit, just do their MCQ practice. That is going to be helpful also. If you have got a BPP or the Kaplan kit, just do their MCQ practice also. Yes, yes, yes. This is the actual examination question that you are looking at. These are the actual examination questions that you are looking at. Okay. Now let's move a bit forward. So we have actually done this question now, and we are going to move forward and do another of the past examination question. September, December 21. Not this one. March, June 22. Okay. Now there is this another example in front of you. What I'll just do is that I'll just open it up. I'll just zoom in. So that you could see the whole question. Okay. Okay. Now here there is basically a question. The name of this is Tanza Company. And it says that currently have got the following sources of finance as at 31st December. Now, can you just read through it and can you just try to see that if you could do something with respect to the calculation of cost of capital? Take 2-3 minutes. Okay. Now let's just start off. So it says Tanza currently has the following sources of finance at 31st December 2006. The capital structure and its nominal values have not changed for many years. So ordinary shares, the 6% convertible loan notes and 4% bank loans and so on and so on. Now again, we have to calculate the weighted average cost of capital. What do we have to do? We have to calculate the weighted average cost of capital. Now, if we have to calculate the weighted average cost of capital, how would things be? Let's try to understand. It says the ordinary shares are currently trading at $5.55 per share and have a nominal value of 0.5 per share. An ordinary dividend of 0.85 per share has recently been paid. So that's a recent dividend. Directors have indicated a dividend of zero point 0.9 will be paid on 31st December 7, which is the next year. Tenza's dividends and share price have grown steadily at 0.6% per year for several years and are expected to continue to do so. Each loan note has a nominal value of 100 and is currently trading at this. On 31st December, investors holding convertible loan notes may convert. So again, it's a similar type of question. Then they need to raise further finance and so on, so on, so on. Now let's just try to see. What is the requirement? It says calculate the after-tax cost of capital of Tanza at 31st December 2006 on a market value basis. So what is actually going to happen is that there is this source. There is this cost in terms of percentage, cost in terms of dollar, sorry, the value in terms of dollar, the cost in terms of dollar. So there is this ordinary shares, 6% bonds, 4% loan. What's going to happen now is that the ordinary shares, um, for the ordinary shares, the number of shares is going to be 50 million divided by 0.5, 100 million. Value of each share is 5.55. Total equity value is going to be what? Is going to be this into this. So equity value is going to be triple five. Equity value is going to be triple five. Now what next is there? This is about the ordinary shares. If I talk about the cost of equity calculation, what information do we have? We don't have anything. We just have the dividends. So the D naught is 0.85. D naught 1 plus G is gonna be 0.90. The growth rate is 6%. P naught is 5.55. Okay, I'll just repeat. I got the number of shares like this. 50 million is the nominal value and $0.5 per share is the nominal value per share. So it's gonna be like this 50 divided by zero point 0.5. It's gonna be like this 50 divided by zero point 0.5. 50 divided by zero point 0.5. Right? Okay. So now if we have to calculate the cost of equity, the KE is equivalent to D naught 1 plus G is this divided by P naught plus G. What happened to it? Equals to bracket open into divided by plus G. What's going on? Okay. So the cost of equity turns out to be 22.22%. 22.22% is what it is. Now, the 6% bonds, loan note has a nominal value of $100 and is currently trading at this. Investors holding the convertible loan note may convert the loan notes into 20 ordinary shares. If they choose not to do so, the loan notes will be redeemed at nominal value at 31st December 9. So like how many years into it? We are right now at 31st December 6. So 7, 8 and 9, 3 years. So you got to see that with respect to the convertible loan notes, the existing value is gonna be what? The existing value is gonna be 150 million of loan note divided by 100. So gives you total number of loan notes. And then you multiply it by 108.51. So 162.765. How much is it? 162.765. Then what happens is redemption value is 100. Conversion value is gonna be what? It is convertible into 20 ordinary shares. 20 multiplied by 5.55 multiplied by 1.06 power 3. Because right now we are at 2006, so 7, 8 and 9. So loan note holders would opt for conversion. Loan note holders would opt for conversion. What would happen? Loan note holders would opt for conversion. I repeat, loan note holders would opt for conversion. Now, what's gonna happen now? Try to understand this. So cost of loan notes is gonna be like this. You would again say here, you would say the cash flows. 0, 1, 2, and 3. So at time period 0, you would show this as an outflow. Sorry, not this. 108.51 as an outflow. Then it's a 6% convertible loan note, 6% multiplied by 100 multiplied by 1 minus the tax rate of 0.15 gives you 5.1. And in the final year, I've actually assumed both of them, the interest and the principal. The IRR is gonna be what? IRR bracket open these values and you get an IRR of 11.2194% or 11.2% is the IRR. So hence resultingly what happens is this is going to be this multiplied by this gives you 18 point something. Okay. Now what next is there? There is a 4% loan note also. So it says that 4% bank loan. Okay, I'll just show you the calculation of conversion. See, each share, each loan note is convertible into 20 shares. Each share has a market value of 5.55 right now. The share price is expected to grow by 6%, and there's a 3 year till maturity. – 6% is the growth rate also. See here, this line where I have highlighted, right? Okay. Now let's move a bit forward and let's discuss further. So what is the next aspect? The next aspect is that we have been able to calculate the weighted average. In fact, no, not yet. The 4% bank loan. Uh, it's simply untraded, non-traded debt. If it's 4%, so it's like 4% multiplied by 1 minus T. T is the tax rate, which is 0.15. So hence, resultingly, what happens is this is what it is going to be. And the overall cost of capital is going to be 17.38%. What? 17.38%. Right? Is that okay? Now, there is this other area of the question also during the company, the Tanza company needs to raise a further $200 million of long-term finance, and directors are discussing whether this should be borrowed or raised by the new issue of equity shares. Finance is needed quickly for the new project. During the discussion, Director A proposed the use of debt. She had heard that at high levels of gearing, the company can make cost savings, which improve the weighted average cost of capital. Okay. B pointed out that Tanza's capital gearing is amongst the lowest in the country. Our competitors generally have a higher gearing than we do and have a lower weighted average cost of capital than us. Although I think when gearing gets high, the WACC goes up again. Okay. Now, critically discuss with reference to the relevant theory the view of Director A and Director B on raising the new finance. Discuss two other factors for Tanza to consider in making the decision to raise debt or equity finance. So now it's a 10 mark requirement that we have in here. And what we need to do is that the views of director A, the views of director B. Okay. What is the relevant theory here? One of them is a traditional theory. One of them is the model, with tax, without tax. The third one of them is with tax. The third one of them is with tax. So it says critically, yes, you can, but again, what happens is that it says critically discuss with reference to the relevant theory, the views of director A and director B on raising the new finance. Okay. For the cost of capital, different theories are in existence amongst the widely used theories include traditional theory, the Modigliani and Miller, which is without tax and with tax. As per the traditional theory of WACC, as per the traditional theory of WACC, as per the traditional theory of WACC, the cost of capital reduces when the gearing increases, as the debt is generally cheaper than equity. However, once the gearing starts increasing a lot, the overall risk of the company keeps increasing, and hence the shareholders demand a higher return. Resultingly, after a certain level of gearing is reached, the increased cost of the equity outweighs the benefit arising because of the cheaper debt, and hence the cost of capital starts increasing. The Modigliani and Miller theory without the tax assumption states that total cost of capital remains unchanged at all levels of gearing, as the higher proportion of debt requires a higher risk of risk for the shareholders to be compensated, and the hence the cost of capital remains unchanged. However, Modigliani and Miller with tax proposition states that Modigliani and Miller with tax proposition states that Modigliani and Miller with tax proposition states that the tax savings arising from the increased debt outweighs the increased return that the equity providers desire, and hence the weighted average cost of capital keeps reducing as the gearing keeps increasing. Now, the comments made by okay, comments made by Director A are in line with the MM2 model, that is MM with tax, which suggests that increased gearing would lead to additional cost savings due to taxation, and hence the overall WACC would reduce. With respect to Director B, the comments made by Director B are appropriate in this respect that he has mentioned about the gearing having an impact on reducing WACC, but after a certain time, WACC starts going up. This is in line with the traditional theory of WACC. However, it is contradictory to the MM2 model. Okay. Then the examiner says discuss two other factors for Tanza to consider in making a decision. Okay. I'll just explain the MM through different things. Let me just explain. Okay. Now see what happens is that if you are having a problem in understanding this theories, so let me just draw a diagram for you. So maybe you could understand through the diagram. Now you see what happens is that when we talk about the cost of capital, so this is the traditional viewpoint. What is the traditional viewpoint? The traditional viewpoint is the cost of debt is constant up to a certain level and then it goes up. The cost of equity is going up and up and up. So basically the initial impact on this specific cost is that the WACC reduces and there comes a time when the WACC is at lowest level and then it starts increasing. Why? Because what happens is that over a period of time, when the gearing increases, so ultimately the cost of debt also increases and the cost of equity also increases because there is actually going to be more risk. There's going to be more risk. Okay. Now when we talk about so Modigliani and Miller no tax model, what does it suggest? Let me just give you a bit of an idea. What does it suggest? It suggests that let's say for example, um, if there is a company, if there's a company which does not pay any tax, so what happens is that the KD remains the same like this, and the cost of equity is like this. So there is actually the weighted average cost of capital remains the same irrespective of the gearing. This is without tax. Now let's talk about the with tax. So what do you mean by with tax? Try to understand this. With tax is gonna be like this. The with tax actually says that this is KE, this is WACC, this is KD. So it says that as the gearing increases, so ultimately the tax savings arise and that leads to the overall WACC to go down. So now you see the difference between these three. The traditional theory says that the gearing actually, when the gearing increases, so automatically you've got more debt, which is a cheaper source, and that ultimately reduces the cost. But at a point of time, the equity providers face more risk, so they demand higher return, and hence ultimately what happens is that we end up paying a higher cost, right? Then with the no tax, it says that whatever you do, the WACC would remain unchanged. With tax, it says that there is going to be a tax benefit of the cost of debt that will keep on arising, and then the WACC would keep on reducing, right? So that's how it is actually going to be. Okay. Now what happens is that, so this is what it was. Now it says discuss two factors for Tanza to consider in making a decision to raise debt finance or equity finance. So what other factors? I mean, like the cost is obviously considered, impact on the value of the business, the duration of the loan. So you have to consider that the impact on the value of the business. The lower the WACC, the higher the value of the business would be, as the present value of the cash flows would enhance. Duration, it is always better to go for debt rather than equity, as debt will not dilute shareholding of the existing shareholders, right? So that's how it is going to be. Now, do you understand this now? So we have actually completed this question also, and I hope that now you people have an idea that how do we actually solve these questions, how do we actually go about. So just in case if any one of you has got any questions to ask, you're most welcome to ask, or else we will just conclude the session here, because we have now covered up the cost of capital also. We'll meet up again tomorrow inshallah, and we'll continue about the other areas of the syllabus too. So I hope that you are okay. You want me to repeat the part B just solved? Okay, see what happens is that with respect to part B, it actually asks that what are the other factors. So the cost of capital would also impact the value of the business, because you would remember from the cash flow perspective, the lower the WACC, the higher the present value. The lower the WACC, the higher the present value. And then duration of the financing also plays a critical role. Duration of the financing also plays a critical role, right? I'll just try to do that inshallah. I'll just try to do that. Okay, guys. So thank you very much. Hopefully you enjoyed the session today also. See you tomorrow, and we'll just continue again. The timings would be the same as what we had today, because like I am getting stuck with something in the morning, so we'll have the same timings as we had today, inshallah. Right? So thank you, guys. Thank you for your time. Thank you for being here. Yeah, 11:30.